Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to calculating cost of ending inventory using the last in, first out method and the first in, first out method, otherwise known as LIFO and FIFO, comparing and contrasting the two. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 424 Calculate Cost of Ending Inventory, LIFO and FIFO tab under the Practice Problems section. Closing this information up, we got the information up top. So we're going to go through, we'll read through the information first, and then we'll be looking at the information in a smaller version so we can work through it within our practice problem. So we're going to be looking at last in, first out, first in, first out. The information, those are going to be the flow assumptions that we are having. So we have inventory, we've got the flow assumptions for the inventory. Typically, we're going to have a flow assumption for the inventory. When we have inventory, that's going to be all similar or the same kind of types of inventory in nature, as opposed to inventory that will be different in nature, such as things that we might do custom for a custom job. So if we're doing custom inventory, making something that's going to be unique to some degree, then we're going to have to, it'll probably cost more, and we're going to have to track the specific inventory. But if they're all the same, then it's probably not worth our time to track the specific inventory that's being sold, but rather use some type of flow assumption. The two ends or spectrums of the flow assumptions that we can use, LIFO and FIFO. The two questions often asked in a book problem question, and the two sides of the equation we're typically looking at is the cost of goods sold calculation and the ending inventory calculation. So we have the beginning product costs are going to be the materials. So this is going to be what we're going to start with. We're going to say we're producing the inventory, but we can use these flow assumptions if we were in a retail situation as well, simply purchasing, marking up, and selling the inventory. So we got the materials cost 5, labor, and overhead. Whenever you think of the manufacturing process or any kind of inventory, you want to think about breaking it into these three components: the material that goes into it, the labor that goes into it, the overhead, all other things that are going to basically go into the production and the cost of the inventory. The beginning inventory in units, 9,700 units produced. Then we're going to say these are the production in the time period of 22,000. The material costs of these new units are now $10, and the labor and the overhead is the same. So the cost is different. The beginning units were $5 for the material, and now they've gone up to $10. So I would think about that as a normal situation where the prices are increasing, prices rising. That's going to be the normal situation. That usually results in first in, first out, making you look better, assets being higher than under last in, first out, and the cost of goods sold being lower, making net income higher. And then you want to reverse those assumptions with last if there was decreasing prices. We're going to be using the first in, first out method, and we'll compare and contrast that to the last in, first out method. The sales in units are 28,000. So this is the sales information, and the sales price is going to be $22. So we're going to sell them for 22. Remember that the sales price has nothing to do with the cost. We might use the cost to determine the sales price, but when we track the cost, it has nothing to do with the sales price. We will be focusing in on tracking the cost. Okay, so here's a shorter version of that same material. Let's go through our process. We've got the cost of the inventory, the beginning inventory. We're just going to break out these sections of the cost of the inventory that we are producing, and then we'll go through our flow assumptions using that information into our flow assumptions table, which will look like this, breaking that out into the product, sales, and ending inventory sections. So right here, we're going to emphasize the fact that we have the material, labor, and overhead in these costs. So we're starting off with the 9,700 units. 9,700 units. Unit cost for the beginning inventory was $5. So $5 for the material, then the labor, then the overhead. You want to think of these three components as components of the cost of any inventory. Now, if you're in a retail company, you'll just simply purchase, mark up, and sell the inventory. But still, at some way along in the production process, these items were part of the inventory that's are being produced. So if we add those up, the 5, the 4, the 5, 5, and 4, we get the $14. So the 9,700 inventory times the $14 per unit, that being comprised of material, labor, and overhead gives us the total beginning inventory of the 135,800. So we have the 135,800. Then we produced more inventory during the period. We produced 22,000 more units of inventory. So 22,000 more units that were here. We've got the same material amount. But then, we have a different materials amount. It was $5. Now it's going up to $10. The labor and the overhead remain the same. So we're going to say, all right, then unit costs $10 for materials now, labor $5, the same, and overhead is now the same at $4. So the total unit cost is now 19 as opposed to the 14 for the beginning inventory units. If we take that 22,000 times the 19, we're going to get to the 418,000. Adding the 418,000 for the new units we produced that cost $19 and the beginning units at the 135,800, which cost $14, we have a total dollar amount of units of inventory of 553,800. So this is just emphasizing what the inventory had that we had available to sell during the month time period. Now let's take a look and break that out into our first in, first out flow assumption. First in, first out, meaning we're going to assume we sold the beginning inventory units first, those being the $14 inventory units. So when we think about the inventory units, we're thinking about selling the $14 units first and then the $19 units. So first in, first out, we're going to have the beginning units. Beginning units, we had the 9,700 units that we started with up here. We're saying that the cost of them are going to be $14, which is the 5, and the 4. That's going to give us, if we multiply that out, the 9,007 times the 14, the 135,800. Then we have the current month production, what we produced in the current month, that being the amount of the 22,000 units produced. They cost the $19 per unit, which is 10 plus the 5 and the 4, which remained the same. So that's going to give us the 19. And if we multiply the 22,000 times the 19, we get the 418,000. That's going to give us our total then that was available in units. We had available the 31,700 units. And in dollars, that comes out to the 553,800. Then we're going to think about the units that we sold. Now I'm going to say sales here because these are the units that we sold, but we're not focusing in on the sales price. We're not focusing in on revenue. We're focusing in on cost of goods sold. Given the fact that we have first in, first out method, we will assume that of the units we sold, 28,000, we sold them at 22, but that we're looking for the cost per unit now. So don't let that 22 throw you off. It has nothing to do with what we're doing right now. So we're going to say that we sold 28,000 units, and we're going to say that we cleared out then the beginning unit number. So the ones that the 9,007 that we had, the first ones that were like in the beginning inventory, those are going to be cleared out. So the cost of goods sold is going to be that 9,700 times 14, not 22, that's the sales price, times 14. That's going to give us the 135,800. Then we're going to say the difference is what we sold to get to that 28,000. In other words, if we sold 28,000, the math would look like this. We're going to take the 28,000 minus the prior portion, 9,700. That means we sold another 18,300 of the 22,000 that were at the price of 19. The 18,300 times that 19 is the 347,700. So if we add this up, then we've got the total of the 28,000 units. And then if we add these up, the cost of goods sold is going to be the 483,500. Okay, so what's left in ending inventory now? So this is what got taken off of the balance sheet and then put on the income statement as a cost. This is what's left on the balance sheet, has not yet been taken off. And that means that we wiped out this column, these 9,700 minus the 9,700. There's 0 units, in other words, at the $14. And 0 times 14 is 14. And of the 22,000 units that we had at the $19 cost, 18,300 of them were sold. Therefore, if we take the difference between the 22,000 and 18,300, we get the 3,700 at the cost of the 19. 3,700 times 19 is going to give us the 70,300. So that means that we have 3,700 at the 70,300 left over. Now, once again, you can kind of shorten this down if it's a book problem you're looking at to do basically this first component. And then if they ask you for the cost of goods sold, you're looking for the ones that were sold, right? So you're going to be saying, all right, I'm going to figure out that's the 9,007 at the 14, and then the 18,300 that would be at the 19 to get to the 28,000. If they ask you for the ending inventory, you can count backwards instead of doing it this way and subtracting out to see what is left. You can just say, okay, well, that means that we had units on hand. I mean, the total units we had were the 31,000 units, and we sold 28, so 31,700 minus 28,000. That means we had 3,700 left, and they're going to be the ones that came out of the later layers. The later layers are going to be the ones that are in ending inventory, and those would all be in the $19 per unit section here. So you can kind of shortcut this or think about it a little bit quicker for book problems, but I would recommend, learning this format, because this format will work even if there's a whole bunch of layers, even if it's a long problem, and whether they ask you for the cost of goods sold or ending inventory. Now let's figure the gross profit now that we have the cost of goods sold. So now we're going to look at that sales number, which is the 28,000. The sales number is the 28,000 in units times 22 units. So now we get to pick up that $22. So that $22, when you look at a cost problem, a cost flow problem, usually messes people up because they want to do something with that 22 in the costs side of things, but it doesn't play in until you figure the sales price, which we'll do now when we figure the gross profit. So the 28,000 times the 22 is going to give us that 616. And then the cost of goods sold we picked up here was at the 483.5. If we subtract those two, we're going to get the gross profit, kind of the top part of the income statement, the 132,500. So now let's do this again. A similar problem, may not be exactly the same, but a similar problem. And we'll now be looking at the last in, first out. So here's our information. The beginning units now, 4, labor, 5, overhead, 2, total then per unit, 11. Beginning inventory in units, we had 4,100 units in beginning inventory. Units then produced in the time period, 14,200. The cost now for them is $5 for the material, $7 labor, overhead, $4. So this isn't the exact same number of problems that we're looking at, but similar problem. But this time we're going to be using LIFO, last in, first out. Sales in units are going to be the 16,000 in units. The sales price, $19. Once again, that's not going to come into play until we get all the way down to figuring out what the gross profit is. It's not going to be having anything to do with the cost that we'll be mainly focusing in on. So here's the same information, a little bit shorter here, so we can see it as we work through the problem. So we're first going to think about just breaking out what we have in terms of the cost of the items available for sale, including the beginning units and the ones we produced. So that means we're going to have the beginning inventory at 4,100. That's how many units we have. Then we're going to say the cost per unit was the 4 for the materials, the 5 for the labor, and the 2 for the overhead, giving us the 4 plus the 5 plus the 2, or 11 per unit. We're going to multiply that out, the $11 times the 4,500 units. That gives us then the 45,100 in total dollar amount. Then we're going to take a look at the units that were produced in the time period, 14,200 in units. They then have a unit price of $5 for the material, as opposed to before it was $4. And labor is $7, overhead is $4. That's going to give us a total of 16. So once again, the total unit price went up from 11 to 16. We would assume that to be like the normal conditions, rising prices, all else equal, prices will typically rise. In that situation, FIFO will typically make us look better than LIFO. FIFO will result in a greater assets, meaning inventory on the books, and a smaller cost of goods sold, and that means a larger net income. So LIFO will typically make us look worse. When would you want to look worse? Possibly for taxes. That's how I would think about it in my mind, then reverse that under the situation where the prices are going down. So if we multiply that out, we got the 14,200 times the 16, we got the 227,200. And then if we add then the 45,000 of the beginning inventory and the units produced, 227,200, we get the 272,300 units available, or dollar amount available to sell during the time period. Okay, now let's do our LIFO calculation. Same setup. Notice if you memorize this setup, it works for the LIFO cash flow or the LIFO inventory flow assumption as well as FIFO. And then we'll just apply the differences within this table. So I would memorize this table, even though it's kind of tedious to do by hand, but it's not too bad once you memorize it. So we have the inventory, beginning inventory is going to be the 4,100 in units times the $11 per units, which includes the material, labor, and overhead. Multiplying that out, 4,100 times 11 is the 45,100. We then have the current month production, where we produced another 14,200, and the cost then for those items is the 7, the 5, and the 4, or 16. Multiplying out the 14,200 times the 16 gives us the 227,200. So if we then were to add this up, we've got the 18,300 units available to sell for the time period, and the total dollar amount then being the 272,300, tying out to the 272,300 we came to up here. Now we're going to sell 16,000 units. LIFO means we sold the last layer first. So you want to think of the last layer. So I'm going to kind of do this in reverse. I'll try to open it up this way. We're going to sell that 14,200 first. So we're going to sell these items first, clearing out the units that are going to be at the $16 units, the more expensive units if there's a period of rising prices, and that'll give us the 227,200. Then we're going to eat into the prior periods with whatever we need to do so to get to the amount that we sold. So we can see we sold the 16, which is like the total here. 16,000 minus the 14,200 means we have to eat into here for the 1,800 of the 4,100 units at the $11 of cost. So that's going to be the 1,800 times the $11 cost is going to be giving us the 19,200. 19,800. 19,800 plus the 22,720 is going to give us the 247,000. So then we can see what is left. Now this one is going to be wiped out. So what is left? The second column is totally wiped out. We wiped out the $16 units, and we still have on board the items that are at the $11. So we still have the $11 items. So the 14,200 minus the 14,200 is 0 times 16 is going to give us the 0. So 0 times 16 is 0. Then the 4,100 minus the 1,800 is the 2,300 times 11 gives us the 25,300. So we're left with, in ending inventory, the amounts of, well, I didn't sum them up here apparently, but they're here. So they're the 2,300 and the 25,300 are going to be our ending amounts. So once again, you can see that we sold under the last in first out. We sold the more expensive items first, the 19. That means the cost of goods sold is going to be higher than it otherwise would under the first in first out method, which means net income is going to be lower, making us look worse if there's a period of rising prices. Ending inventory, we have left the older units, the cheaper units on the books as an asset. Assets are good. We have less expensive assets here, makes us look worse than we otherwise would, because our assets would be at the $16 units if we used first in first out. So we look worse on both the income statement and balance sheet under a period of rising prices with LIFO. When do you want to look worse? Possibly for taxes. Then if you were to reverse that, if these were going the other way, 16 being the old units, 11 being the new units, that could happen. Then you just reversed your assumptions, and that would mean that the LIFO would make us look better than FIFO in a case of declining prices. All right, let's go on down to the gross profit then. Gross profit calculation. We sold the 16,000 units now at $19. So 16,000. Now that's the sales price. This sales price has nothing to do with all the stuff we did up here. Nothing to do with the sales price, right? Now we're picking up the sales price at the sales component. 16,000 times that $19 gives us the 304. And then the cost of goods sold we found up here at the 247,000. Therefore, our gross profit 304,000 minus 247,000, giving the 57,000. All right, we're going to do this again. This time, we're going to see that we have a declining price now. So it's going to be the same kind of setup. We got the beginning inventory, the inventory per unit, and now we got those units being $29.50 as the cost of the beginning units. And then we're making more units, and they cost now $28.10. They cost less. So now we have that reverse situation. So we're going to be doing this with, and then we have the sales amount. We're going to be doing this with LIFO. So notice now we have a period of the prices going down over time. So I would think of it as in normal situations, LIFO makes us look worse. This is the reverse of the normal situation. LIFO then will make us look better than FIFO. And just keep that in your mind and think about that as we go through the calculations. This is going to be the opposite. LIFO is going to make us look better than FIFO because we're in the reverse situation of rising prices rather than declining prices. So we have the same information here, so we can take that information, same kind of layout we've seen in the past. If we were to calculate our total inventory once again, we're going to say the beginning inventory was 10,000 units. They cost, materials cost $15, labor costs $8, overhead $6.50. That gives us $29.50. $29.50 for the beginning units times the 10,000 units gives us total $295,000. Then we have the new productive units being 44,300. They cost, unit cost for the materials $14, then labor $6.80, and $7.30 for overhead. Total unit cost then being $28.10. $28.10 times the 44,300 gives us the $1,244,830. And if we add then that amount plus the $295, we're going to get the $1,539,830. Point being that now the $28.10 is lower than the $29.50. So the units we produced are now lower in unit cost than the beginning inventory was. So then if we go down to our LIFO calculations, we're going to say then beginning inventory, we had 10,000 units. Those cost the $29.50. $29.50 here. And if we multiply the 10 times the $29.50, we get that $295,000. Then we're going to be producing more units, those being the 44,300 units. Those cost us the $28.10, the 14, the 280, the 7.3. This being less than the prior units, so we have declining cost. And if we multiply the 44.3 times the 28.10, we get the 1,244,830, the same as this number up top. That means in units, we have available to sell 53,300, and in cost, that means in dollars, that comes out to 1,539,830, comprising of 10,000 units at $29.50 and 44,300 units at $28.10. So then we're going to assume we sold these units. We're going to sell the later units first. We're saying 48,000 units. We sold them at $40, but remember, that's the sales price, not the cost. We're dealing with the cost here. So we're going to wipe out the second column. The 44.3 are going to be completely sold out. Those cost the $28.10. So we're selling the older units, which are now the cheaper units, right? The cheaper units are being sold, and that's going to result in the cost of goods sold being less than under FIFO if we were to use FIFO, and that's going to make the net income higher, making us look better on the income statement, because it's the reverse of what would normally happen due to the fact that we have declining prices opposite of the norm. Then we're going to cut into whatever we need for the 10,000 units that were at the $29.50. What do we need? That calculation would simply be, well, we sold 48,000 minus what was in the last layer, 44,300, providing the fact that we need 3,700 of the units that cost $29.50. And the 3,700 times the $29.50 gives us the $109,150. What's left then? If I go bottom to top, once again, the 44,300 minus the 44,300, we now have zero left at the 28.10. 0 times 28.10 is going to be 0. Of the 10,000 units, we sold 3,700 at the 29.50. That means that we have 6,300 left at the 29.50 for a total of the 185,850, and that's going to be what we have left, the 6,300 units at the 185,850. Once again, we have the older units left, which are now the more expensive units due to declining prices. So you can see that we actually look better Under LIFO, which is the opposite of what would normally happen, because the units on ending inventory, which are assets, which are we want to look good. If we want to look good, we want the asset valuation to be higher. Then it's higher here than what it would be under FIFO. So once again, emphasizing the fact that when you look at test questions or just how these assumptions will work in your mind, first in, first out under normal circumstances, declining prices. Normal circumstances, increasing prices. First in, first out will make you look better, and last in, first out will make you look worse on both the income statement and balance sheet. The reverse will happen in a case of declining prices, as is the case here. So then you just memorize the norm, then flip the norm in your mind when the opposite happens, the norm being increasing prices due to, if all else, inflation, all else equal, inflation causes increasing prices. And then if some other circumstance took place that causes decreasing prices, then you flip your assumptions on the effect on the financial statements in general, making you look better or worse than under the normal conditions.